Hi and Assalamualaikum. My name is Muhammad Muaz bin Muhammad Irfan. Alongside with my other members, we will be presenting our portfolio management analysis. Alright, here we go. Okay, for the introduction, this assignment will be analyzed on the measurement of the risk and return for our selected stocks from the Bursa Malaysia. Therefore, throughout this assignment, we will go through some analysis, which is security, portfolio, and comparative analysis. Why? Because we want to determine which stock we want to invest in. So our chosen stocks come from different industry as per requirement with at least 5 years of establishment. Right. The other requirement that we have to meet for the selected industry or stocks is the EPS has to be in a positive state. Apart from that, includes a minimum of 10% of its return on equity, or we know it as ROE, and the market performance must be in an uptrend movement. So it has to be a bullish market, right? So why does we want this positive state? Because with higher EPS or positive EPS, then we would know that the company would be able to generate a profit to their shareholders. So that is why it is important to have a positive EPS and also a positive return on equity. So our first stock that we have chosen comes from a technology sector, which is Dufu Technology Corporation Berhad. So Dufu Technology Corporation Berhad is a Malaysia-based company which is engaged in investment holding. The company is engaged in the manufacture of industrial products and trading of computer disk drive related components. It offers products which are categorized as precision turning products, precision machining products, metal stamping, sheet metal fabrication, tool and die fabrication, and plastic components. Alright, so why does we chose Dufu Technology Corporation Berhad? It's because it currently has a fundamental rating of 8. So you can just see it on the Bursa or maybe iSaham, you can see the fundamental rating. It has an 8, so which is a solid result, which is significantly more bullish than the machinery and heavy vehicles industry group average of 5.8. So the company's gross margin also and current ratio has been higher than its industry group average for each of the past 5 years. The company's recently announced the return on equity was at 25.202, meanwhile the earnings of 0.098 per share. So Dufu currently has also an EPS in a positive state. So that is why we chose Dufu Technology, because they still able to generate profit to its shareholders. So if we can see by this pie chart below here, we can see the rate of return, even though from 2018 to 2019 they actually have a decreased amount, but in 2020 they came back, or the amount rise back again. So that is that shows a good movement from the market. And then from the average of return, we have a total of 102.554%. And then the risk, we have the variance of 1401.15%, standard deviation 37.43%, and the coefficient and variation 0.3650%. So for the CV or coefficient and variation, we want to make sure that the CV has to be lower. So the lower is the better. So that is why we chose Dufu Technology, because it has a lower than 5%. Thus, it makes it a good movement for the market.
Assalamualaikum warahmatullahi wabarakatuh. My name is Niki Adila Muhammad Zamri from BA114 5CU. Now I'm going to discuss the stock B. The company that we chose for stock B is Top Glove Corporation Berhad. Top Glove Corporation Berhad is a Malaysia-based company which is engaged in investment holding and providing management services. The company provides its products to various industries such as aerospace, automobile, beauty, food, home care, laboratory, medical or healthcare. The products include in the company such as latex powdered gloves, latex powder free gloves, nitrile gloves, stretchy vinyl powder free glove. The reason why we chose this company as a stock B is because of their performance throughout the pandemic. As you can see in the table, the average of return about 79.29%, which is above 60%, it shows that the company of the performance is good. Okay, so as you can see in risk perspective, you can see there are variance, standard deviation, and coefficient and variation. In variation, you can see the amounts about 1,302.47%, and the standard deviation about 115.34%, and the coefficient and variation about 1.4547%. Next to the table, you can see there is pie chart which about rate of return. We simplified into pie chart. You can see in 2016 the percent, it's quite low. Really low, about -8.4%. And we proceed to 2017, you can see it increases even more, which 65.7%, and continue through 2018 about 49.6%. 2019 it's going down again, which -12.03%, and 2020 it's even more increases, about 301.59%. Hey, it's me again. Now we're going to proceed to the next stock, which is stock C. So the company that we chosen for stock C is Vitrox Corporation Berhad. Vitrox Corporation Berhad is a Malaysian-based electronics company located at Penang, Malaysia. Vitrox Corporation Berhad is a company from the technology sector, with semiconductors and semiconductors equipment being their sub-sectors. Vitrox Corporation currently has an earnings rating of 9, which is significantly more bullish than the semiconductors industry average of 6.4. Vitrox scores a bullish 7 or greater for 2 of 3 companies' ratings. Currently, the company announced quarterly earnings of 0.09 per share, as well as 25.5% of their current return on equity as for October 2021. As we can see in the table, the average of return about 70.80%. In risk, we can see there are variance, standard deviation, and coefficients and variation. The value of variance about 7531.79%. The standard deviation about 86.79%, and the coefficient and variation about 1.1922%. As you can see next to the table, there is a pie chart which shows of rate of return in the year of 2016 to 2022. To 2020. In 2016, you can see the percentage about 12.57%, and it increases in 2017 about 236.3%, and it's going down a little bit in 2018 about 2.22%, and 2019 about 26.60%, and the last one is 2020, which about 86.33%.
Hello and Assalamualaikum. My name is Teku Denaldi, and right now I'm going to talk about stock D. Our stock D, which is Nestle Malaysia Berhad. Nestle Malaysia Berhad is the company mission is to harness the power of food to improve the quality of life for everyone, now and in the future. The products are such as KitKat, Milo, what's that? Nestum, Maggi. So they are creating creative culinary solutions under the well-known such as Maggi brand. This resulted in the development of the company's first production plant in Malaysia. After more than a century in the nation and in the hearts of nations, Nestle company is devoted to providing the finest in terms of quality, nutrition and flavor. On 24th August 2021, earnings per share was 57.37 and the return on equity was 20.49. And the reason we chose this stock because it has a good condition in the market and the global. So in the table shows in 2016 the rate of the return is 10.52 and the next year would increase to a fat amount to 35.49 and the next year increase even more. 2018 was 45.54 and then it dropped drastically to 2019 in which was 1.63, then even more in 2020 being negative 3.93. This resulted an average of return of 17.85 and the risk of variance is 373.82%. And the standard deviation is 19.33 and the coefficient variation is 1.0829%. Okay, next I'm going to talk about stock E. Stock E we chose Axiata Group Berhad. Axiata Group Berhad is commonly known as Axiata, formerly known as TM International Berhad, is a Malaysian multinational telecommunications conglomerate with extensive operations in Asia. It is one of the largest wireless carriers in the country. Axiata's primary business is investment, holding and the provision of telecommunications and consultancy services on international scale. Okay, their main focus is being emerging markets in ASEAN, ASEAN, and South Asia. Axiata Group Berhad products and services include prepaid, postpaid, mobile services, in even television broadcasting and cable television services, internet services, enterprise solutions, digital marketing and e-commerce services. And also mobile advertising and machine-to-machine solution among others. The rate of return in 2016, as you can see in the pie chart, is negative 25.16%. Then the next year it increased to 18.15%. Then the following year is they dropped to negative 26.73. Then the next following year, 2019, was 7.78. And the recent 2020, it dropped to negative 8.96%. This resulted in average of return of negative 6.984%, which is quite low, but it's not bad. So, and the risk is variance. The variance of risk is 378.66%. The standard deviation is 19.545%, and the coefficient variation is 1.1019%. Okay, next I'm going to talk about the KLCI index. The Kuala Lumpur Composite Index, and the short form is KLCI, now known as the FTSE Bursa Malaysia KLCI is a capitalization weighted stock market index composed of 30 largest companies on the Bursa Malaysia by market capitalization that meet the eligibility requirements of FTSE Bursa Malaysia Index Group rules. Currently, the index is jointly operated by FTSE and Bursa Malaysia. It was first introduced in 4th of April 1986 as the Kuala Lumpur Composite Index with a base value of 100 dated on 1st January 1977. The pie chart shows the rate of return of the KLCI index is negative 3.0 on the 2016. Then the next year increased to 9.45%, then decreased in 2018 to negative 5.91%. Then the following year increased slightly even more to negative 6.02 and increased to in the latest year for 2020 of 2.4%. And this resulted of an average of return of negative 0.612%, and the risk of variance is only 34.969%, and the standard deviation is 5.89, and the coefficient of variance is negative 9.66%.
Assalamualaikum and hi, my name is Muhammad Hanif bin Ahmad Saribuddin and I'm from BA114 Today I'm as a fund manager. I want to talk about portfolio analysis. The security analysis has been done for stock A, B, C, D and E. From the analysis, it shows that covariance for stock A, Dufu Technology Corporation and B, Top Glove Corporation Berhad is lower for one unit of risk compared to stock C, D and E. Based on that, the portfolio manager decides to choose stock A and B to be included in the portfolio. For the covariance, the purpose of covariance is to measure the directional relationship between two returns and two assets. A positive covariance means that asset returns move together, while a negative covariance means they move inversely. Based on the security analysis, stock A and B shows the lowest coefficient and variance. It means lower risk compared to other stocks. Covariance Dufu Nestle is 506.25. Covariance Dufu Axiata is negative 249.36. Covariance Nestle and Axiata is negative 33.32. Okay, next to the correlation. The purpose of correlation is to measure the strength of the relationship between two variables. Present correlation relation is the one most commonly used in statistics. This measures the strength and direction of a linear relationship between two variables. Values always range between negative 1 strong negative relationship and positive 1 is strong positive relationship. Values at or close to 0 imply a weak or no linear relationship. P Dufu Nestle 0.96997. Percent Dufu Axiata is negative 0.3755. Percent Nestle and Axiata negative 0.0972. Return on portfolio. The portfolio manager has selected two stocks to include in the portfolio with the weightage of 70% for stock A and 30% for stock B. The return on portfolio in the portfolio manager includes stock A and stock B in the one portfolio are as follows. Return on portfolio is 44.2814, and for the risk on portfolio is 18.8470.
Based on the security and portfolio analysis that we have calculated above, it shows that the return and risk perform well, but we still have to compare our performance with the KLCI index to indicate whether our portfolio is underperforming or outperforming the market. From the table, we indicate that our portfolio is outperforming the market on both the return and risk. Our chosen stock of companies which are Dufu Technology Corporation, Nestle Malaysia Berhad and Axiata Group Berhad have proven that the accumulation of both return and risk of portfolio has greater risk than the market, thus creating more return, which is more likely to risk-seeker investors who prefer to invest in stock with higher risk and higher return. Based on the data, our return on portfolio is 44.28%, whereas for the risk of the portfolio, our risk is 80.49%. To sum that, To sum things up, in context with risk-averse investors, our investment strategy is more suitable for risk-seeker investors who are willing to accept greater economic uncertainty in exchange for the potential of higher return. For the conclusion, based on the analysis that we have been done, it shows that our chosen company have the potential to give higher return for those investors, thus making it suitable for investors that are willing to accept any risk, unlike those who want to choose to preserve capital. As a risk-seeker investor, we believe that our chosen stock will stick into the bullish movement and generate more expected return. Not to mention that as a risk-seeker investor, we will also accept any losses. For the 200,000, we have used 20% of it to invest in stock, Dufo Technology Corporation, 50% to Nestle, and another 2% to Axiata Group. For the recommendation, after we made some calculation of each expected return, we ensure that to continue our investing toward the issue Dufo Technology Corporation, Nestle Malaysia Berhad, and Axiata Group Berhad, because both the return and risk on the portfolio are above 10% and also greater than the market. We were convinced to proceed our investment into the selected company as our final result. So that's all from me. Thank you.